Hello traders, we continue our intensive with you, and in this lesson we will talk about the market structure. In fact, the market structure is the basis of technical analysis. It is the basis of the price action system. It is the first thing you must start with, to figure out what the market structure is and how the market moves, because it will depend on what position to open, short or long. So we have three types of movement. This is a bullish movement, an uptrend. This is a bearish movement, a downtrend, and sideways movement. They call it differently: sideways, range, flat, and so on. What is the difference and how to determine the trend? An uptrend is when we have new higher highs. So, we have highs and lows of the price. This is called high and this is called low, abbreviated as H and L. And in an uptrend, each hour high is higher than the previous one. This high is higher than this high is above that high, and we don't have a lower low. The lower low is when the price makes like this. Here it makes a higher high, and here it makes a lower low. Again, it is not a lower low if the low is higher than the previous low, and we have higher highs only. In a downtrend, there is the opposite situation. Each hour low is lower than the previous one, so there are lower lows and there are no higher highs. This means that we are in a bearish trend. In a sideways trend, the price moves chaotically, and we have two types of ranges. Thus, if the price goes up, then we start to mark the range by the first high and then the first low. These are our sideways bounds, and these breakouts are called deviations. These are false breakouts. The price goes here, takes all the liquidity and returns to the flat. We can understand that this is a range only after we have formed the bounds. We see the first high and the first low. And we have two deviations. In this case, we have a confirmed flat. We understand that the price in it will move randomly. If the price goes down, then we start to mark the range by the first low and then the first high. And we also see two deviations, which confirm that this is a flat. It is important to understand what the trend is. There is such an expression among traders: the trend is our friend. If we understand what our trend is, then we understand which direction we will trade. If we see that the trend is up, the price is moving up, then we enter the long positions. We buy cheaper and sell more expensive. If we see a downtrend, then we sell more expensive and buy cheaper. This position is called short. If we have a sideways trend, then we enter the position after deviations. If the deviation is from above, then on the test we can enter a short position. If it is from below, then on the next test we can enter a long position. So, we should enter after the price makes a false breakout and test the bounds of the range. In the range we can work in two directions. It is important because we are trading probability and mathematical expectation. And the probability that the price will make a higher high in a bullish trend is much higher than it will make lower low in a bullish trend. This means that the potential of a long trade will be higher than a short one. So, if we trade according to the trend, then our trade will be safer because the probability of a higher high is higher than the probability of a lower low. The same is here. If we see a bearish trend, then the probability of a lower low will be higher than the probability of a higher high. Definitely, it's more interesting for us to enter a position where the mathematical expectation will be higher. In this case, it will be short because a lower low is more likely than a higher high. And in ranges, we work from one bone to another one, like here, and we must open a position after the breakouts only, because by these breakouts the market maker removes the liquidity zone. Other words, he goes for retail traders' stop losses, and we must escape such traps. First we wait till stop losses of retail traders are taken, and after that only we enter the position together with the market maker to make a profit from this movement. We are not concerned about high highs or lower lows in ranges, we work from bound to bound here, because the price inside the flat can move chaotically. Since we work with stop losses, it's important for us to determine the trend change in time. If suppose that we get profit in this position in a bullish trend, then we enter here again and get profit in this position. We enter again here and get profit as well, and the price starts moving down. And we decide to take a long position in this zone again, because we assume that the price can go up again from here and make a higher high. But that doesn't happen, and we have a lower low. Then here our position is closed by a stop loss. We lose here. As we have earned much here, then this loss does not make much sense for our trading result in general. And secondly, we see that we have a break of market structure and there is a high probability that the price will start moving down. And we have to work with short positions. So, if you see that there is a lower low and if the next high doesn't make a higher high, then most likely this is not a sideways movement, but a change of a trend, and the price start moving down. Here is the same situation, but with a high high. Here we see a break of market structure, and there is a high probability that the trend changes. So, our main goal is to define the trend correctly and trade according to it. And if we have a break of a trend, and even if we catch a stop loss, we need to make a new analysis of the market and realize that most likely the trend has changed, and you need to change your mood from bearish to bullish and vice versa. Now let's see how it works on the chart. So let's look at the Ethereum chart. That works on any time frame, and let's start with a one-day time frame now. The most important thing is that we need to find the low that makes the high and the high that makes the low. Here is the low that forms this high. This high forms this low. This low forms this high. This high forms this low. There is a manipulation here. Actually, we can consider it, but it is better not to do this on a high time frame. This low forms this high. On this high time frame, we are interested in this high. It's more important than this one. And this high forms this low and so on. It is also important to pay attention that here we have a break of structure. That is, the price grows up, makes a lower low, then does not make higher high, and the price moves down. But that is about a higher time frame. An important point is that highs and lows on a high time frame will differ from highs and lows on a lower time frame. Now let's look at a lower time frame. For example, 1 hour. And here we see either sideways trend or anything. Let's check this area, for example. Here we have a high on a high time frame, and downward we have a low on a high time frame. On a 1 hour time frame, everything looks a little different. Here we have a high, which forms this low. And then we have this high, and here on a lower time frame there is a sideways movement. Then we have this low and this high, and again the range. We see deviation here and then the price moves down. Then we can start to work with this high and this low. This high, this low, this high, and then the low is down there. There is a slow down trend there. We don't see definite lower lows here, but it still looks like a downtrend. Of course, sometimes it would be not clear whether this is a downtrend or a sideways movement. If you cannot understand quite well what's on the chart exactly, it's better to skip trading it. So next, here we get this high, there will be a sideways movement on a lower time frame too. Here we get this low, and here we have a range, and it can be marked in several ways, like this. Here we have deviations, and here is deviation. If at the moment you don't see this part of the chart yet, you can mark this flat from this high to this low. This is our first high. Here is the second one, like this. We don't consider this low until we see the whole situation on the chart. We can trade this range quite easily for some time. Further, when the situation changes, yes, it gets clear that we need to consider this low and this high. First you trade this zone, then the situation changes and you can view the chart in a different way. And in fact, when we made a lower low and this high isn't higher than this high, it is clear that we have a downtrend movement on a high time frame. And this must be considered, because our task is to use multiple time frame analysis. And then we have this low and this high, which forms this low and this high, which also forms that low. These small movements need to be looked at on a lower time frame. As well as these movements here, it is also better to consider it on a lower time frame. Well, then we go down to this zone, and here we also have a range. We see the first low and the first high, and this is a range. Here we see a good range. There are two definite deviations. 1, 2. So we can enter the position here. And here in the same way we can enter a position from here and there. Here we have longs, here we have shorts. Here we have longs again. It is important that when you enter a position in a range, your first take profit should be on the 0.5 Fibonacci line, and the second take profit is here. And conversely, if the price goes down and you hold a short position, then your first take profit should be here, and the second one is here. We can check the range by price reaction to the 0.5 Fibonacci zone. That means when you mark the range, the price should react to this Fibonacci level. Here it is not visible enough, but still you can notice the price is testing this zone. Here we see a test, one more test, a test again and again. Sometimes 0.5 zone is quite obvious in the range. It doesn't happen always. If you have a range where the price tests 0.5 Fibonacci zone definitely, such range is supposed to be more confirmed than that range where the price doesn't show such a reaction. If you don't see any reaction at all, if you have questions about the flat, then it's better to skip it. It's better not to trade this range because the price moves chaotically in a flat, and you can both earn very well on and lose very well on it. Now let's check, for example, 15-minute time frame. At 15 minutes you can see more movements. Here we see a range from a high time frame as well. There is a downtrend, we get the first low, then the first high. So we mark the range. Here you see the price react to the 0.5 zone. That means it's more confirmed range. We have two deviations here and more from below. When there are more deviations below and less above, very often the price goes up from such a range. Of course, that doesn't happen always. It's just the chances are higher to go up than down. At the beginning it's better to trade ranges within its bounds and do not expect that the price will go out of it somewhere. Now let's look at some other movement uptrend 50-minute time frame. Right here we have low high, low high, low high, low high, low high. Here we have a 50-minute structure and uptrend. All is the same. The main task is to find correctly the low that forms the high and the high that forms the low on each time frame. If there is something incomprehensible, it is better to skip it. The main idea is not to trade everything in the world, every movement, but our task is to choose the ideal cases, and the cases with questions just to ignore at the beginning. When you become more advanced traders, then you can understand where and what details can be, how to react to them, but at first it's better to trade those zones that are more predictable and understandable. An important thing in trading is to learn how to use different time frames. We need to point highs and lows from a high time frame, and at the same time enter positions on a low time frame, considering both the higher and lower ones. Let's look at some other chart because the situation here is not obvious. Now we see the atom chart. Open the high time frame one day. Again we mark high and low. Here is the high that forms this low. This low forms this high. Then here is the low and this high. From a high time frame the chart looks like this, and we understand that we have a downtrend here. And in fact we have to short here. But as it is a high time frame, it can take a lot of time to wait for a short position. The price correction can go to the zone of interest where we can take a short position and keep it for a very long time. It can be a month, two, and sometimes even half a year. It depends on what time frame we work with. If we open 1 hour time frame, the situation is different. We have an uptrend here, and we see this low that forms this high that forms this low, and so on. And this is the long structure. So here we can try to find and enter long positions. But we must remember that here we cannot expect the price to make a higher high from a higher time frame, because our price is in a downtrend, and this high has formed this low. Or we can take this high as a basis because it has formed this low, so we have high, low, low, high. There is a range here. After that, the price goes down, this is a flat. And we have this high that forms this low. And then there is another structure here, uptrend. We can trade longs quite easily here on a lower time frame. We just have to realize that more likely the price will not make a high high right here. When you watch the next lessons, you will understand more. Now use this general information for better understanding what the market structure is. We must understand that in some situation we enter a long position till a certain zone, and then we must turn into shorts because the whole movement is still downtrend. And this uptrend on a lower time frame does not break the structure of the downtrend on a high time frame. This idea you need to catch. We must have time frame synchronization. If we go a counter trend on a high time frame, then we must determine the zone to which we have the right to hold our long positions. And from that short zone of a high time frame, we turn into shorts. If you learn how to synchronize time frames, then you will be able to enter good positions in any market and whenever you want. The information is rather simple, but it might be not clear from the very beginning. You might need some more time to understand it better and have a look at the charts. Be surely you will succeed very soon. If you have any questions, feel free to write them either in the comments or in our Telegram channel. We will answer them, and maybe I will record more detailed video, or I will make a stream where I can answer your questions. Click the bell, subscribe to our channel, and feel free to ask any questions. Let's cooperate and earn from the market together.